if you don't know where to begin, better ask Win.
Shane, good to see you. I'm glad we had time to talk today because I really want to ask you about the recent market volatility. Concerns about a cooling U.S. economy led to a market rout recently, with the Dow down as many as 1,100 points. Stocks and treasury yields paired some declines after service sector data came back better than expected. Of course, we know to expect volatility and corrections. That's part of being invested in the market. But I want to show you this chart from FinViz, which shows the S&P's 1 month performance. When we see this much red, Shane, how do you explain this volatility?
Well, it was a pretty tough time there in early August that led to all this red. And a big part of it is the fact that we see these tech stocks, which make up a huge proportion of these indexes, the S&P, the Dow, and the like. They took a bit of a tumble, and they had been so high that it was actually kind of expected, right? They were so high, they had grown to such high levels that it was about time for a bit of a correction. So when we saw those stocks start to kind of come down, it really affected everything greatly because they make up such a large percentage of those overall indexes.
I'm glad you brought that up because, of course, it has been a very strong year for tech. But when they slide, it brings us up something that we've talked about before, which is concentration risk. Shane, how 82% of the market movement is due to only 10 stocks.
Exactly, and it's if you look at this pie, that kind of puts it in a pretty simple visual manner. 82% of it's made up by all these big tech stocks. So when they move, everything's going to move. The overall index is going to move, and therefore it becomes pretty unnerving when you see movement in those stocks as everything starts to move. But something to think about, something to keep in mind, is the fact that 1,000 points, 1,200 points down, that used to be a much greater percentage of the overall index or of your portfolio than it is now, right? 20 years ago, 1,000 points was a huge percentage. Nowadays, 1,000 points, 1,200 points, maybe 2-3%. So it's not as dramatic as it might seem on the surface.
Right. That context is really important. I'm glad you brought that up. And of course, being invested in the S&P is not a diversified portfolio. How did diversified portfolios withstand that recent volatility?
They did pretty much as they should, right? When you hear diversification, it means spreading out your investments across multiple areas. So if you had all your money sitting in those tech stocks, you would have taken the brunt of that drop pretty significantly, and you would have really felt the pain in early August. But if you had a diversified portfolio, maybe even a portfolio with some structured income, bonds, the like, to start to kind of hedge some of these drops, you're doing just fine. And of course, you would have caught that upswing that came after the drop, and things have kind of stabilized.
I'm glad you brought that up because, of course, we all feel like the sky is falling when we hear these headlines. And I had just been on Google that Friday when it broke in early August, Shane, and I was typing in, should I? And the first option on that drop down there was sell my stocks now. So people were clearly feeling anxious. What do we keep in mind when we hear these scary news stories?
Well, that Google screenshot there is pretty much an exact representation of people's mindsets. They start to panic. I think I should sell it now. I got to get out before it goes even worse, right? But what happens when you do that is you absolutely lock in, you guarantee yourself that loss. And if you look at what the markets did following that drop, they came back up. So those people that sold when things were, low, missed the upswing that came back. They guaranteed themselves that loss and locked it in. And that's definitely not what you want to do. And a professionally managed or an appropriately positioned portfolio, of course, should be designed to kind of weather these storms and not need to cause panic.
Right. A Google search is not a financial plan. Well said. So Shane, if somebody would like to create that financial plan with you, how can they reach you?
Best way to reach us is online or via phone. Our website is winstonandcompanies.com, or you can call us here at the office, 602-456-1928.
Great. Shane, thank you.
Thanks, Erin.
Got a plan for your retirement, 'cause you know it's just down the road. But if you don't know where to begin, better ask Win.